Hi, everyone, and welcome back to another simple daily practice drill that I think you can use to become a better trader. And this is called market replay. Hey, this is a kind of generic name for a drill, Tim. What's going on? Well, in this drill, what I'm going to do is I'm going to use market replay from NinjaTrader, but I'm going to do it in 5 different ways. I'm going to come up with 5 possible trading strategies, and then I'm going to replay today or yesterday. I'm going to replay yesterday's price action, doing my best to follow that strategy. Now, when I'm following the strategy, I'm doing my best to focus on execution. And that's the key to this drill. Because if you start to bring in what you think, what you expect, what you know, you're going to make mistakes on the execution, and then it will be hard to compare the results. The goal of this exercise is to look at how different strategies perform in a different environment. So first, I'm going to take you through the drill instructions, and then I'm going to outline the 5 different approaches I'm going to use. Now, in this video, I've got market replay on a very high multiple, and there's no sound. So you're welcome to scrub through that if you like. But also, if you have a chance to scrub through the video and find the entries, and you'll see what I'm doing. Then what I'm going to do at the end of the video is compare all of those 5 outcomes and talk about the different statistics and what this is telling me about this particular type of trader on this particular type of day. And this kind of practice is really, really valuable because it takes all the price action knowledge that you know and puts it into, can I actually execute it? We're not machines. And that means we're going to make mistakes. When we look at a chart and say, that was the best trade of the day, well, yeah, but I was already in a trade that was failing. I wasn't able to take that trade because my strategy said I had to take the earlier trade. And these are the little details that I think is really important in putting together a strategy that's going to work for you as a day trader. So the day I'm talking about is this one. So this is the day I'm talking about. We opened in a bit of a tight trading range. We had a really strong bull breakout. It looked like it was going to get an even stronger second leg up. We had a huge reversal. And then we basically were in a bull channel for the rest of the day. But these kind of days in my past would take a lot of money from my account. At this point here, we're in a bear channel. It looks like it's going down. At this point here, it looks like a big bull breakout, and we're going to go higher. Well, at this point here, you're confused. Oh no, it's just a wedge bear flag, and we're going to go down. Oh, but we didn't go down. Oh, maybe it's going to reverse from there. Oh, no, it didn't. And then we got a new high. So this is a great day to practice a couple of different strategies. Okay, so let me take you through the 5 options. So here are the 5 different strategies I'm going to use today. Strategy 1 is a buy the close, sell the close strategy. I'm going to chase price the same way a dog chases a car. I'm just going to run after getting long and then run after getting short. But I'm going to use a wider stop, about 2 times my signal bar, and give time for my trade to work. So that was strategy 1. Strategy 2 is going to be still chase price, buying the close, selling the close, but I'm going to add a scale in below that signal bar, okay? Because scaling increases profitability, so I'm going to add that in. That's exercise 2. Strategy 3 or exercise 3 is going to be about second entries. When I trade a second entry, I'm going to look for second entry longs, second entry shorts. And if I'm in a trade, I'm also going to get out of it if a second entry appears. And I'm going to try and execute that strategy. Strategy 4 is I'm going to use a bit more patience. I'm going to wait for a pullback into the lower third of a channel or a trading range. So I'm going to let the breakout go, and I'm going to wait for the pullback into that bottom part of the range. Or if we're going down, pull back into the top part of that range. So you can see in strategy 4, rather than chasing signal bars, I'm going to really focus on risk reward. So I have a small risk and a big reward. Whereas the 3 strategies before, sometimes the risk and reward is a bit out of whack. And then in strategy 5, I'm going to use even more patience. Rather than taking the signal bar when it appears, I'm going to wait for the signal bar to work. And then I'm going to enter below that bull bar, have my stop at the swing point, and then I'm going to scale in about halfway down to my stop. And if I'm getting short, I'm going to wait for a sell signal to appear. I'm going to sell above that signal bar and sell 50% higher to my stop. So you can see in all these 5 strategies, the ones that have the least amount of patience are going to be 1 and 2 and 3. The ones with the most amount of patience are going to be strategy 4 and 5. And let's see how they perform. I've put chapter markers in the video, so you're welcome to click through and see them. I'll do a brief summary of that strategy afterwards, and then right at the end, I'm going to bring all the strategies together. So how do we go in strategy one? Well, you can see here, market opened, we had consecutive bear bars. So I thought, okay, sell the close. And then I had a stop up here. It very quickly got run in about 6 bars. And then I had consecutive bull bars. So that was buy the close with a stop down here. And that went all the way up to target. So why didn't I sell again on these bear bars? Well, I moved my stop to below that bar, and I would have been happy to get out below that. We've got to break out and follow through. I probably want to get out because this is going to have a second leg down. But my stop never got hit. And you'll see in the recording, I moved that stop up, but it didn't get hit. And I got taken out. So only 2 trades, 4 or 5 hours. I lost 9 points and then I made 13.5 points. So a small profit day. You can see here 4 points because we're trading 1 micro. And let's have a look at the results. 2 trades, 1 winner, 1 loser. Average winner is bigger than average loser, and that's good. But you can see even with this hit rate, it's going to be really difficult to find that edge and capitalize it in these kind of days. And in this strategy, we saw our strategy on one and thought, okay, well then I took 1 long, I took 1 short, I didn't lose any money, but I didn't make much. What about if I scaled in, can increase my probability, I might take more trades, and then maybe this is going to help. So let's look at the results for strategy 2. Well, what happened here? Same again, took that short, sold more above that bear bar here, and then finally took a loss all the way up here. So I took a big loss in the first hour. Then I've got consecutive bear bars and I'm no longer in a trade. In strategy 1, I was already in a trade, so I couldn't take the short. But here I'm flat. So now, hey, I'm able to take the short. So I sell the close and then I sell more above that bar, and then 2 times the signal bar up, I take another loss. And then finally, after a few hours, I buy, I'm not able to scale in below, and then I take a profit. So no surprise there with strategy taking big losses. So there were 5 trades, 1 winner, 4 losers. Okay, so really bad stats, and my average loser is bigger than my average winner. And that's a problem. Not only does my profitability suck, but I've got my winners and losers around the wrong way. Now, if you're thinking like, of course you wouldn't do that. Well, the funny thing is that when we learn trading, we learn to buy the close, sell the close, buy above, sell below. We learn to follow price action. But for some reason, when we get the idea of using limit orders and scaling in, this is what happens. This was my experience. The moment I started scaling into trades, all my losers became bigger, but all my winners stayed small. So my risk reward was always the wrong way around. So now let's move on to strategy 3. So in strategy 3, we're going to start putting in a bit more context. We're still going to buy the close, we're still going to sell the close, but we're going to look for second entries. We're going to get in on a second entry, we're going to get out on a second entry. And then when it gets confusing, which it's going to do in any breakout mode on any day in any chart, we're just going to use the moving average and say, is it a better sell or is it a better buy? The additional piece of context we're going to use is if the market's going to be long and it has one reversal, but then the bullish reversal resumption is stronger, then I'm going to stop looking for shorts. I'm going to look at a second entry to get back in. Okay, so this is strategy 3, using second entries to get in, second entries to get out. Let's take a look. Okay, so you can see we're a little bit more active now. You can see on the way down, because that's bar 1 and 2, there was no second entry short, but there was one reversal long and then a second reversal long. So I don't know how many traders bought above that bar. Well done if you did. But for me, this would have been the second entry long, which was a buy. Looking for 1 times that signal bar. Now we've had 1 reversal. Now we've had 2 reversals and I'm flat. So I'm able to sell. So I sell the 2 close. Oh, 1 reversal, 2 reversal, I exit above that. Sorry, I can zoom in. I exit above that bull bar. So I'm out on that bar, 1 reversal down. Okay, but now I've got an even stronger reversal up. Okay, so I'm not going to look for a short below 33. I'm above the moving average, but now I've got a second entry long above that bull bar. Take it and you're out. Reversal down doesn't trigger, but look, I'm flat. 1, 2, buy. 2 reversals, 1, 2, I'm out below that bar. And then 2, I'm long. So you can see now we're back into profitable territory and we're more active. So we made twice as much as we did using strategy 1, which was just kind of blindly buying, selling like a robot. So by putting that additional piece of context in, instead of making 4 points, we've made 8 points. We didn't use any scaling in, so we're trading $5 a point, 1 micro, but you can see how adding context, now these numbers are starting to look a little bit better. Now we've got 60% profitability, 5 trades. Finally, we've got more winners than losers. We can also see here, average winner is bigger than average loser, and biggest winner is bigger than average loser. And this is really common in any kind of second entry strategy. We really want these numbers to be round the right way. If we're going to take losses, the losses should be smaller than our winners. So now we've done that same day 3 different ways. Now we're going to layer on an additional piece of context with strategy 4. Strategy 4 needs context. And context says, and I'll bring up the chart, context says I'm in a bear channel. So if this bear channel breaks, I don't really want to start betting on a bull breakout. I'm going to bet that this is going to turn into a trading range. It might be here, it might be here, it might be here. We don't know where the top part of this range is, but the next market structure that's going to appear should be a channel. Now, this is a bit of context that we didn't add in the first 3 strategies. We were just looking at bars, enter, exit, I'm a robot. Now we're going to look at the price structure and say, okay, we were going down, everyone was short. If that breaks, we're going to be in a trading range, but that trading range is probably going to be slanted. Which way is it going to slant? Well, if everyone has been trapped low, every time we go up and pull back, I suspect those bears are going to get out. They're probably not going to hold and they're probably not going to add. So we're going to be slightly slanted up. And that means coming into the session, I want to avoid buying high until it's very clear and very safe for traders to buy high and make money. So let's take a look at strategy 4. So coming into the session, this is a spike. We waited for a 2-legged pullback or a pullback into the lower third, and we bought exit when we go above the high. You'll see in the recording, we've got a new bull spike, a fib. I have a fib marked up. Apologies, it looks so crude. First is the spike down. Rather than just putting a limit order in space, wait for price to stop going down and go sideways, and then it missed my order. I then, once it spiked up, tried to buy 50%. I thought, no, let's do that differently. Now we've got a new spike. Now I'm going to buy in the lower third again, exit at the high. So taking profits at prior highs. Then same again. Here's a new spike. Wait for it to come back into the lower third, buy and exit. So this strategy itself required you to be very patient. You had to be quick on the draw early, but then it was a long time between drinks all day. Every 2 hours, you had something to do. You can see in terms of performance, now we made 20 points on that day. And on a day that had a range of about 40 points, to be able to take half the day's range is really, really good. So, okay, well, I read that day really, really well. Now let's take a look at this. So we had 3 trades, we had 3 winners. So now all the stats are totally the opposite. Now, is that unrealistic? Well, it's certainly excellent performance. That means I've read the price action and I was able to maintain that strategy all day. But when rubber hits the road, it's probably not going to be as good as that. You probably would have missed a few entries. But even so, you were facing the same way as the market. The market never gave you a reason to switch. In that particular strategy, it never created such a strong bear spike that you needed to reverse. The proviso I would add to that is, well, what if you saw this as a bear spike and you look to sell somewhere in here? Now, I couldn't take that trade because I was already long. But let's imagine you sold there. You had plenty of time to decide it wasn't working. 3 opposite bull bars against you, probably good enough reason to exit. And if you practice this strategy a lot, what you'll find is a lot of the traders that were short somewhere in here with a stop up here switched back to long. And if you're flat and you see that, you say, oh, actually, I think everyone that was playing this as a trading range is going to get stuck now. We're probably going to go and hit their stop up here before we go and hit the stop down there. Let's move on to strategy 5. Now, strategy 5 is the most patient. Because we expect a channel, we're going to keep the context from number 4. What we're going to do is we're going to wait for a signal to trigger. Okay, bull bar, looking good, goes above it, happy days. We're going to buy below that bull bar. And then if another really good bull bar sets up, okay, we'll buy below that. We're going to have our stop at the swing point based on how you judge it. And we're going to have one scale in. Now, in the second strategy, what did we do? We just scaled in below the bar. You can see here, instead of entering and scaling in below that signal bar, we're going to wait for the signal to trigger. We're going to enter below the bar, and our scaling is going to be half the way to our stop. So if we get stopped out, we get stopped out. But we're betting on the maths of a channel and a trading range to help that scale in, rather than getting top heavy in a trade when it fails. If a trade fails, which many of them do, so you can see my first entry was above that bear bar. And where was my stop? I think my stop was somewhere Oh, my stop was up there. So I sold above that bear bar. That's a bit of a surprise. I sell again 50% of the way to my stop. Apologies, apparently I suck at shape. So sell more, and I got stopped out. On to the next trade. Now I've got a good bull bar here, 11. So I'm going to buy below there. I think the stop was somewhere down here. And then at the 50% point, I buy more. So I'm automatically back to my entry on the next bar, but the indicator told me that my total risk and my average position size 1-to-1 was up here. So that's where I got out. My next trade, well, I was trying to buy below good bull bars, but it never happened because I'm in a strong channel. My first entry is there, my stop was here, and my 50% is there. Then the indicator says, there's your 1-to-1 up there. You can see in this strategy, we performed better than 1. We performed better than, but not better than 4. In this strategy as well, you can see our hit rate is back to where we need it to be. Average winner and loser are equal, which is not great. Bigger than biggest loser is good. Summary of all strategies. Well, thanks for watching if you made it this far. So we played the day with 5 different strategies. At first, we removed all context and we just focused on the signal bar. Okay, it's a good bull bar, buy. It's a good bear bar, sell. Oh, it's consecutive bull bars, buy. Oh, it's consecutive bear bars, sell. We made it really simple. That didn't work out very, very well. It didn't work out very badly, but it didn't work out very well. And one of the reasons was we had a wide stop and a small target. So even when it's going to work small. Then in strategy 2, we decided to use scaling because intermediate traders think that if I just add a position, somehow the trade is going to magically perform better. But we can see that was the one that performed the worst. And if you're learning trading, you've probably had that experience. You thought you were doing something that was really useful, and the result is huge losses. And that's showing you step 1, you're still trading without any context, and you're adding positions, but the probability hasn't changed. Okay. And the probability can't change because I haven't put context into my trading. In strategy 3, what we did is we said, okay, I'm still going to be looking to buy the close, sell the close, but I'm going to wait for a second entry. If we're going down, first pullback, I'm not going to buy. We go down again and have another buy signal, then I'm going to buy. We're going up, pause. That's 1, 2, I'll get out. And we use that to stay within the market. And this one performed much better. It avoided us from being in big losing trades. Then we added even more context in strategy 4. We said, okay, rather than getting hung up on the signal bars, I'm going to buy bull bars, I'm going to sell bear bars. Yep. I'm going to wait for second entries. Yep. But I'm also going to look at the context and the market structure of it being a breakout pullback channel. So I'm taking that second entry, but I want to be low in that channel when I take it. So my risk is small and my profit target's large. And then in the 5th, expecting the market to be in a channel rather than taking all the signals high, so buying above things, selling below things, we thought, no, we're going to do something different. We're going to wait for that signal to work, wait for the pullback, and then I'm going to buy below and that signal, or I'm going to sell above that. So I'm going to naturally trade it more like a channel. I'm not going to benefit from an explosive upside if it doesn't come back, but I'm also not going to get trapped anywhere. I'm going to basically follow the moving average. Instructions for homework. If you're using market replay and you can turn the speed up, you can play through the trades and then click, slow it down when the bar's about to close to see what you need to do. And that's going to allow you to trade multiple strategies of the same day. The advantage of practicing this drill is that if you're in a session and you keep doing the wrong thing, rather than being stubborn and following that feeling, say, you know what, I remember practicing these kind of days. This is the kind of day where there's a different strategy I should use. Rather than me get upset with the big loss I just took and then become more aggressive, think, okay, it didn't do what I thought it was going to do. Is there another strategy I can trade? And you'll find if you have that approach, you won't miss out on all the moves. You'll actually avoid taking a second larger loss, because if you traded something that was high probability and it didn't work, there's a whole bunch of other computers and traders who did exactly the same thing. The difference will be in attitude. Can I keep applying my strategy, keep applying my price action reading skills for it to come back to green? Or am I upset? I can't live with the loss. It's like a stain on my computer and I need to get rid of it. And that mindset is going to force you back into strategy 1 and 2. Chase. And you can see what happened. By chasing and do that, you never made a lot and you had a chance of taking a big loss. Hey, well, thanks very much for watching this video. I hope you found it valuable and good luck in your trading drills. My name's Tim Fairweather. You've been watching Zen Trading Tech.